All right, let's go ahead and get started. So for those of you that are new, and there's a few names I don't recognize on today's call, which is great. You've got the chat button and you've also got the Q&A button on your Zoom panel, which are usually at the bottom for most people. So feel free to utilize those. You're welcome to interrupt me as we go along, and I'll answer questions as we progress. So don't feel like you got to wait till the end. Okay, so let's get started. So if you don't know me, I'm the managing partner of Trophy Point. We are a private lending fund on real estate assets. I love real estate. I've owned quite a bit of real estate in the past. I also teach real estate entrepreneurship at Georgia State. I am an Army officer, former Army officer. Actually, I'm still in the reserves, so I guess I'm still an Army officer. And I went to West Point, Emory, and Georgia State for my education. More than anything else, I've got a lot of experience. I like to think I have a lot of experience. And so if you've ever got a question or conundrum as it pertains to real estate, hit me up. I love helping people save money probably more than anything else. I think not losing money is the name of the game when it comes to real estate versus making money. And there's a distinction between the two. And the little quote you see at the bottom of this, Mike Martin, he'd asked me about a small apartment complex he was trying to buy, and I basically gave him some questions to ask, and it turned out his seller was basically defrauding him on the sale, and Mike was able to avoid that through some of my help and guidance. So I always love those stories. So feel free to hit me up. My phone number's there. My email is also at the bottom. Hit me up anytime. So if you don't know what we do, and there's a few names on few people I don't recognize on today's call, so I'm just gonna briefly go over what we do. Trophy Point is like a private bank. We take your money, we give investors, you, an 8, 10, and 12% return, depending on how much money you put into the fund. And then we take your money, we lend it out, just like a bank does, at higher rates. And a spread is made. The investors get the majority of the interest, and then a small spread is what's kept by me and my partners as the manager owners of the fund. And that's different from other funds that take like a profit share. We take the position that you have to be paid first before we're allowed to make any money. And then to that end, I have $8 million of my own money, plus a little bit from Dave and Nick. And we take the first loss on any bad deal, bad decision that we make. And we eat it all completely, our entire 8 million, before an investor's principal is touched. So I like to think we're quite aligned with the decisions we make with that of our investors. And we offer a lot of stability to you. We always take a first position lien. So we're always secured in a senior fashion on anything we do. So we always have real collateral, real assets that we can go after to get our money back. We like to focus on military folks, typically. That's typically who our borrowers are. And that's helped us keep defaults quite low, actually. We haven't actually lost any money on a net basis from any of our loans. And we've done 1,000 loans so far, actually. And I'll show you where we've done it and all that. So I'm quite pleased about that track record. And if you're understanding, like, want to know where we fit in asset classes that give you a sort of semi-fixed return or a fixed return, you've got REITs, treasuries, high yield dividend stocks, emerging debt. All those asset classes are available to you, and Trophy Point, our offering surpasses them in terms of the yield that we offer. So I'm really pleased on this call particularly to announce some of the major milestones that we've hit. We crossed 1,000 loans, which is fantastic. We've originated $210 million, which is amazing. But even better than all of that is that we've gotten paid back on $125 million as well, which, if you've heard me on previous calls, I like to say that any idiot can send money out the door. It's getting paid back. That's the real test of a private lender. And I'm very pleased to say that we've gotten paid back on most of our loans, which is not unsurprising because most of our loans are in 6, 9-month, and 12-month increments anyway. So they're very short-term in nature. We had our annual meeting last month, and I hope there are a few names on the call today that I know were at this annual meeting, but the meeting went really well. We were able to donate a little bit of money to the Warrior Alliance, which is a nonprofit here in Atlanta that supports veterans and veteran-related activities. We got our team to come in as well, which is the middle picture that you see here. Those are all the team members that support Team Trophy Point on the loan processing, closing, and origination side. And then you can see some of the photos of other investors as well. And this year was a little different. It was less about me presenting and more me just answering questions from the audience, which I think was a much better format. I ended up answering questions for about 40, 45 minutes, which I enjoyed. It makes it a lot easier for me to, one, I don't have to prepare, but two, it keeps it fresher because rather than me just droning on and on for 60 minutes, I get to hear what's on your mind and what you want to talk about. So I hope you can make the next one. The next one's going to be probably April. We're starting to host these at the end of April, at the end of the first quarter, which usually coincides with the completion of our audit. It coincides with the completion of our fiscal year, which is basically the calendar year. It makes more sense to do it at the end of April than in September, which is when we had done it in the past. So the snapshot as of April, we've got about a $94 million, $93 million balance sheet so far. Loan originations have maintained the same levels as the end of 2024. In fact, Q1 of 2025 was our highest quarter ever, actually, of originations. We originated about 23 million of loans. And interestingly, in March, we got paid back more loans than we actually lent out, which is even better in some ways. It's good to have a couple months where you're just getting more loans paid back than loans that you're making. So in quarter one of 2025, we got paid back on about $15 million of loans as well, which is great. It's a sign of a healthy lending environment because loans go in and loans should be coming back. That's the sign of velocity. That's a sign of transactions happening. So I don't see any slowdown of transactions, at least for us, for the segment that we serve. And we hit 250 investors as well, which is probably another milestone. And we're paying out 600 grand plus a month in investor payments. So here's a quick snapshot as of today. We are in the middle of May. So we have grown a little bit since April, obviously. The blue dots are our paid off loans and the red dots are our active loans. And so we've done, 1,000+ loans at this point, and we've got about 350 loans outstanding at any given time. And you can see all those red dots, they're all spread out quite a bit throughout the country. We may stop showing this map, honestly, because the way the software does these dots, the dots are just really superimposed on each other. So you really don't get to see like the full breadth of it anymore. We like to stick to certain markets, as you can kind of tell by the concentration of these colors. We're very big in North Carolina, South Carolina, Georgia, Texas. Those represent our biggest states, actually, in terms of loans. And in many cases, we're lending pretty much multiple loans and sometimes in the same neighborhood. That's why the dots are kind of like right on top of each other. And so that's the concentration. Now we're military affiliated lenders, meaning that the people we serve typically are veterans, typically people that are in the military still. And we lend primarily around active duty military bases, which is why you see a lot of these dots where they are. There's an Air Force base outside Boise. There's Fort Lewis outside Seattle, which is the Tacoma area. If you're wondering why we have loans near Ciudad Juarez and south of Tucson, those are home of military Army installations as well. Let's see, we've got a question, I think. I'll go ahead and... Will asks, is there any reason why the West is sparse? Yes, great question. So we like to stick to areas and markets where there's job growth and population growth. If you have kept up with some of the news regarding real estate, the Southeast and the East Coast has actually benefited more so from job growth and population growth, which are the two main demand drivers of real estate to begin with. The other reason is that, I'm based in Atlanta. Our team is basically East Coast based anyway. So just the nature of the relationships that we have, we're going to see a preponderance of more deals on our side of the country. And the third thing is, I would say like California probably represents the biggest market on the West Coast. And we don't lend in California, primarily because of regulations. The laws that California has are not conducive to good lending. And frankly, I don't want to lend in an area where the deck is stacked against me when it comes to foreclosure law and things like that. But we will lend in Washington because it is a great state for real estate, actually. It is growing as well. So we do make exceptions for Seattle and Boise. But we really don't see ourselves ever going into California, Nevada, Oregon, Wyoming, Montana. Like those states don't have the population growth that really buttress and really promote rising real estate values, which is what we are lending into. We're lending into situations where someone has a not so great property. They're going to put some money into fixing it up, but because it's a popular area, it's going to produce a higher after repair value once the repairs are made. And so we want to lend in environments where people want to move to and are willing to pay higher premiums for fixed up properties. And that's kind of the nature of flipping and real estate investing as a whole. Great question. We do have a referral program. So if you're an investor on this call, we do pay $1,500 either in cash or you can add it to your investor account if you'd like. I know some of you have taken great advantage of this program already, and we're happy to pay the referrals for introductions. So again, quick note on what we do. We offer debenture notes. We offer fixed rate returns, and the best way to think about us is standard and non-standard, or standard and retirement. I think we're the best option for retirement-based accounts. Any amount you put in above 25,000 yields you 10%, which compounds automatically on a quarterly basis. So your yield ends up becoming 10.3%, and it's a great way for your retirement dollars to grow tax-free. And then if you don't want to invest retirement dollars, we've got 8, 10, and 12 based on the thresholds that you see there, 25,000, 250,000, and 2.5 million. There is a lockup of 18 months, but after 18 months, you can ask for your money back anytime after that with 90 days of notice. And I'll point out that, I have $8 million of my own money invested, and I take the first loss on any bad deal or bad decision we make. So I think you're in bed with a fund manager that really is aligning risk and really thinks very thoughtfully about the risk before we just sling loans and sling dollars everywhere. Will asked another question. What is your read on the DC area market due to federal government employee drawdown and impacts of tariffs on real estate? I'll get into that, Will. That's a great question. I know that's probably the biggest question on most people's minds today, and I'll get into that as I dive into some of the market data. The team has grown, by the way. We are 35 people deep. Half the team is overseas based in the Philippines that do the majority of loan processing paperwork and loan closing paperwork. But their managers are Americans, which you kind of see the middle row here. And the Filipino team supports our managers who are outward facing and customer facing as well. All right, so let's get to the heart of why we're here, which is what's happening in the market. So tariffs, every time, I still haven't published my quarterly letter. And I've probably sat down 10 times, no less than 10 times, to finish my quarterly letter. And each time I sit down, something has changed on the tariff front. April 2nd was when Liberation Day was announced, when the tariffs were announced worldwide, quite literally. And since then, almost every 3 or 4 days, some piece of news pops into the market that changes the game. I would say changes the outlook of all of it. And does he make it higher? Does he make it lower? Does he make exceptions? Countries are coming to the table now to renegotiate, all that. And that's happening right now. And over the last 2 weeks, China and the United Kingdom and Canada, to some extent, have I wouldn't say capitulated by any means, but they have signaled interest and in some cases signed agreements of rolling back some of the tariffs and all that stuff. So in the short term, I have no idea what the tariffs are going to do to real estate. I don't think it's going to affect it much, though, because we're in the residential space. There's a shortage of houses, as I'm pointing out here. And if you look at the data, like the housing inventory across the country is still lower than it was, in the last decade. And we're still short on houses, and our population is still growing. It may not be growing as much, but it's still growing. And builders are not building as much as they should be building to keep up with the growth of the population. So I feel like those three sort of dynamics are always going to have a shortage of housing, produce a shortage of housing, which is great for us because we want a shortage of housing, because that will basically keep up, or at least maintain the property price levels that we're seeing, at least in the markets that we're in. And it's estimated about 7 years it'll take to catch up if builders continue to build at the current pace. And that's taking into account maybe a reduction in interest rates, which would make building a little bit more attractive. And the average house is 40 years old too, by the way, which is an excellent sort of market for flippers, for people that are trying to buy houses that are not so great shape, fixing them up and then reselling them for a profit because they've added value to it. And so, Will, you asked about DC as well. I think I have a chart here of population growth. So, the data is only as good as, pretty much 2024 that I could find, that I trust. And there's a lot of data providers out there. I'm discovering that a lot of data out there contradicts itself. So it's very hard, actually, even for us to pinpoint where growth is happening. But this chart that you see in front of you, you'll see a lot of Georgia, Texas, South Carolina, Georgia, Texas, Florida, Texas, North Carolina, Texas, Florida. You'll see a high number of counties and areas still in the United States, southeastern part of the United States. So we're focusing on areas where population is growing. And the data is not in yet, Will, to answer your question about DC. It looks like, obviously federal employees are being cut. The last number I heard was around 200,000 federal employees. But is it all limited to DC? I don't think so, actually. I think a lot of those employees are outside of DC more than anything else. That being said, we are looking at DC with a lot of caution. And the way we translate that caution into the deals we do is by producing lower LTVs and having the borrowers put down more money. We're talking 15, 20% down, actually. Whereas before, for hard money lending, for private lending, we would have normally asked for 10% down. But in many areas, especially in Florida, actually, even though it has a lot of people going there, Florida is also experiencing an exodus in certain cities of Florida. So in those areas, we won't say no to deals outright just because of the location, but we will ask for more dollars down. And that's our way of controlling for the risk. To the point where like the borrower would have to be an idiot to walk away because they're putting so much money down, they're producing so much internal equity into the property, into the asset, that if they were to default on us, then we would just take over and, basically enjoy that equity for ourselves, should it ever happen. But I'll tell you this, it never happens for the high equity properties. The biggest news this week earlier on Monday was rates, I believe. And the Federal Reserve had a meeting of the Federal Open Market Committee, and they decided to hold rates steady at where they're at right now. And I think it's because inflation is not yet tamed, like in the way they look at it. I think inflation is still above the 2% target rate. I think it came in at 2.5 or 2.7%, something like that on an annualized basis. So it's not where they need it to be. So they're keeping the inflation rate the same. Inflation does affect us, right? Because inflation is tied to treasuries and the cost of borrowing. And in a weird way, high rates actually benefit us because it allows us to justify charging higher on our loans too. So we don't want rates to go so low that we have to go so low in our rates, but we also don't want them to go so high that it prevents future buyers of our collateral to be unable to buy the real estate that our borrowers are holding. So it's kind of like this dance. And obviously I have no control over rates or anything like that. And the way we translate all this stuff into risk is we make people put more money down. We're being a little bit more selective in our lending. And we're just ensuring that the asset ultimately is something that we would want to own should someone default. We got another question here. Let's see. Donald, I'm concerned that tariffs plus continuation of 2017 cuts will drive up 10-year treasuries. Am I off base? If interest rates go up, how does that affect the Trophy Point Capital business model? So great question. I think it kind of dovetails off of what I just said a moment ago. We actually don't mind if rates go up a little bit because it allows us to charge higher. But we don't want rates to go up so high that it prevents people from being unable, like a future buyer, like a family, trying to buy the flip that we funded a borrower on. I think treasuries will stay the same or go up slightly. I don't think they'll go down, only because the way current monetary policy is being done by the government, I think the current policies are going to hurt our economy in the short run. And we're still operating at deficits. So we still have to print money to satisfy the deficits that are produced. Even though the government, even though the president's making some headway in reducing the federal government sort of albatross, we still need to price our debt in a manner that's attractive to others. And so I think treasuries are still going to have to remain at 4.5% plus in order to attract buyers of that debt, of federal government debt. And that means that cap rates on real estate on a kind of like a global basis, at least in America, in an America universal basis, would have to fall in line, right? Because if the risk-free rate, which is treasuries, is 4.5%, 5%, then you got to get yields of 7, 8, 9% out of assets. Well, when yields go up, what has to happen? The value of assets has to go down. So it's like this little game that we play where we don't want yields to go up so high that the value of assets go down, because then that affects us because our collateral is based on the values of these yields. I mean, is the value based on the asset. So it's like we're kind of in this sideways sort of scenario, which we're happy with, actually. The other thing affecting our business model is the flow of capital. And this is what makes me feel hopeful about what we're doing, or optimistic about what we're doing, is that as long as capital flows amongst institutions, amongst the government, amongst banks, I think we're going to be okay. Because in the real estate game, yes, like I said, absolute values of rates matter for sure. But what matters more is velocity. And I think our economy is adapting to a new normal, obviously, but the velocity of trades is still happening. What would absolutely keep me up at night is when banks stop lending or the velocity of sales diminishes to a point where like people are fire sailing properties in order to get out of them. And that induces a lot of fear and panic. And that's kind of what happened in 2008, where for about 90 days, credit markets capital seized up dramatically and big institutions were actually falling apart because there's no liquidity in the market. We as a fund and frankly any business in America, I would say, is subject to these liquidity sort of dynamics. So if it happens to us, it's going to happen to pretty much everybody and anything in your portfolio. That being said, I think our government and I think the Federal Reserve is really good now. They've got practice with 2008 and with COVID. They know how to introduce liquidity back in to the market, for better or for worse, to keep capital markets still moving. Now, is it going to drive up inflation when they do that every time they do that? Yes. The short answer is yes, it will do that. But I think I think you're better off having higher inflation than having credit markets completely seize up on you, if you had to pick. Let's see here. Will ask another good question. Is there a risk of vacant office building impact the banks, which could impact residential market? Yes and no. So the banks that typically fund office buildings are larger banks, which are not the same banks that fund mortgages typically. So there are going to be a lot of banks in the next 3 to 4 quarters that are going to face what's known as the wall of maturities, almost $1 trillion of real estate commercial debt, a lot of it centered in urban core office assets. Those banks may feel impaired because their building assets, their office building assets are now lower in value, and they're going to have to fire sale, and then that's going to have an impact, a negative impact on the bank's balance sheets. But like I said, those banks that do those type of deals are not typically the same banks that do residential deals. And frankly, there are a lot of mortgage banks, residential mortgage banks now that are really they're called banks because they have money, but they don't have depository relationships. They are in the business of making loans, packaging up, and selling off their mortgages to bigger institutional buyers. So it's not the same. I don't think it's apples to apples when we think of a bank. There's banks and then there's like smaller banks and smaller folks that fund residential mortgages, what we care about at Trophy Point. That being said, again, it all ties back to liquidity. If Wall Street does not want to buy residential mortgages anymore for whatever reason, then yeah, we could be in trouble because ultimately we still need those mortgage banks in order to fund the buyers of our collateral on the back end when the loan is done or when the term of our loan is completed. Great questions. Feel free to keep them coming. Feel free to use the chat. Feel free to use the Q&A button if you just joined us. That being said, so according to Redfin, they've got a great website, by the way, for real estate data that's updated quite frequently. I recommend if you're interested in the space, go to Redfin. I know their chief economist, great guy, great team. Anyway, because of the shortage in housing and the population growth, it's expected that real estate prices will increase. Not by much, but what they're projecting is that real estate prices will increase, which is great. And what I really care about is they're not projected to decrease. Because you always want to lend in an increasing market or values of increasing, right? Because I can lend against that. I don't want to lend into an environment where it's projected that real estate values or home values would decrease. That would not be, if that was to happen, we would probably really stop our lending or really curb our lending. And that's okay with us if we have to stop originations for a few quarters or even for a year for that matter. That's fine with us. But all the data sources that I've looked at show that, it's not going to go down. It's just going to slightly increase. Now, it's not going to increase dramatically either because of what we're seeing with interest rates and tariffs and some of the other economic conditions. But so far, the news is positive insofar that nothing is going to decrease. So one other metric that I look at is the number of days it takes for a house to sell. So they are staying on the market longer. So in 2021, 2022, which is what I would call the heyday of residential real estate, because that's when you had, 2% interest rates, 2.5% interest rates, mortgage rates. Houses are selling like less than 20 days, which is amazing, which has never ever actually happened in the history of the housing market. And then rates became more nominal or more normal. And so now rates are where they should be, I think, in my opinion. And that's leading to houses staying on the market for 30 to 45 days, which I think is great. I think that's normal. What I don't want is what's coming off of 2008. If you go to 2011, 10, 13, you're looking at houses staying on the market for, 90 plus days, 80 plus days. That's not good because it tells me that houses are not priced appropriately. Houses should be priced to sell, to get under contract within 30 to 45 days. I think that's normal from my opinion. And I think houses are pretty much at that point. I don't think we're seeing anything from the data that says that the housing market itself is in bad shape. So another way to look at it is list price to sale price, or sale price to list price. Meaning, if I'm selling a house for $100,000, I'm listing it for $100,000. What am I ultimately selling it at? Well, in 2021, when we had lower interest rates, houses were selling well above actually your list price. If you listed it for 100 grand, you could probably sell for 102, 103, 105 even. Now we're seeing houses being sold at the 98, 99% of list price, which is still great. That still means that sellers are not exuberant with expectations. It still means that buyers are willing to meet the prices that are listed, at least publicly. If we were starting to see price cuts of 10%, list price to sale price ratios of 0.90, then I would say we have a problem. I would say that something is going on data-wise that indicates that the buyers are not buying, which would be a problem for us, and we'd have to really adjust. But so far, it looks like it's fine. And again, you can find this on Redfin as well. So I didn't want to, eat up too much of your time. We're at the 30-minute mark, and I try to keep these calls in the 30 to 40-minute range. I'd love to hear your questions. Feel free. We've covered tariffs, we've covered inflation, we've covered employment to some extent, we've covered government moves, interest rates, the housing market itself. We've covered a lot actually in the last 20 minutes. So feel free to post questions in the Q&A button or in the chat, and I'm here for you to answer them. All right, well, if there are no questions, I'll just quickly, maybe someone's typing a question in or two, but at the annual meeting, I posted this chart of what growth looks like of a hypothetical $100 or $100,000 at the start of our fund, and where our various investors at the 8, 10, and 12% class are today. So, if you invested $100,000 in 2020 and you allowed your money to compound over that time compared to just simple treasuries, for that example, and we've done this without a loss, by the way, our 12% investors would have like $186,000. They've almost doubled their money actually by this stage. Whereas the treasuries, if you invest 100 grand in treasuries in 2020, you'd only have about 136,000. So it's a pretty big premium that we pay. And our 10% investors, which is the most number of investors that we have in the 10% share class, they'd have about 168,000. So fantastic for compounding if you're with us for a long enough period of time. So Brad, I'm glad you brought this question up, Brad. Thanks. So can you talk about how your lending has changed in those markets where inventory is rising, like Florida? And how many loans do you originate per application? So I'll answer your questions backwards. So we originate one loan for every 5 or 6 applications that we get. We're very selective. And it's probably even higher than that or lower than that. The percentage, the success rate would be lower because we say no a lot just on phone calls. So someone calls us up and within 3 minutes, I can pretty much tell who's a good borrower versus not, based on the way they talk about their exit strategy, based on the way they talk about how they found their deal. In those 3 minutes, I can usually tell if it's a good bet or not, to even invite them to fill out an application. And in that case, it's probably even higher. So it's probably like 1 in 8, maybe. Can you talk about how your lending has changed, like in areas like Florida? So that's something I brought up at the beginning, is in areas where we have concerns like Florida, which is facing an exodus. Certain markets of Florida are facing an exodus of people. We're lending more conservatively. Basically, we're asking for more money down, higher credit scores, higher liquidity from the borrower. We're just basically tailoring our lending and making it more stringent in those areas to counteract, rising inventory. To the point where, like, if we wanted to take over that asset at the basis of lending that we were at, we'd still make a profit. Great question. Anonymous attendee asks, more news about private lending taking off more mainstream. Yeah, that's correct. I mean, competition is heating up. There's about, I would say, almost probably $10 billion a month or a quarter, if not a quarter, entering our space every month, every quarter. That's dedicated more to direct lending for what we do. So competition is definitely heating up. It is impacting us. Borrowers want lower rates. They want better terms. And we are doing our best to adapt to that. But in many cases, we're not. I mean, we pride ourselves on our customer service and our ability to close loans and do what we say we're going to do. And there's a segment of borrowers that appreciate that and don't really, question it too much. And so we're trying to stick to a segment of borrowers that appreciate the way we do business. There are lenders out there that you could get lower rates from. but you'll never find a better customer experience with them compared to us. And if you're a professional real estate operator, speed is important. Having a lender that's going to close on time, having a lender that's going to do what they say they're going to do, having a lender that's flexible, that if there's a problem, they're going to pick up the phone, they're going to listen intelligently and thoughtfully about the problem and offer solutions. You're not going to get that from a bulge, hard money lender out there that's got $1 billion under management. You're going to get that from people like us. And I think many real estate investors, the seasoned ones, recognize that. That's why 60% of our borrowers are repeat, which is what we want. And then there's another question: what percentage of your borrowers are investors, flippers versus home buyers, owners? Truthfully, we only fund business purpose investment loans, so it's 100%. We don't fund any home buyers, homeowners, not a mortgage company, consumer mortgage company like that, actually. But if you're asking how many are going to be fix and flip versus how many are buy and hold for rental purposes, the majority of our investors are kind of on the latter side of buying with our money quickly, securing a discount sometimes, because if you offer a seller, hey, I'll close your house in 10 days. I know you're asking for 110, but if I close in 10 days, will you give it to me for 100? A lot of sellers would take that bet. So we're empowering our folks to buy properties at a discount by the speed of our lending to begin with. And then what they do is they fix up the property and turn it into a rental property and then refinance out of our loan with a DSCR or another lending company that does more rental type loans. And so we're really quick, and that's how they use us. And that's like about 70% of our loans. Anonymous asked, do you do in physical inspection of the properties? What type of due diligence do you do? Yeah, so basically we kind of outsource that partially, meaning that we have a third-party inspection, third-party appraisal or evaluation done on each of the properties, and we get photos and things like that. And then we also internally underwrite the borrowers as well, and we mirror the two forms of underwriting, borrower underwriting and asset underwriting, to ultimately come to a loan decision. Great question. Oh, one more question. Let's see here. Anonymous attendee says, appreciate the honesty and transparency. Yep, thank you. So my quarterly letter's coming out, and I apologize it's late because every time I try to write it, the world seems to change when it comes to tariffs. So basically, I finally said in my letter, I don't know, but this is how I'm thinking about the situation as it develops. And that's coming out this week. We're also going to be sharing our little recap video of the annual meeting. It was fun. We had about 100 people attend. And I hope you guys can make the next one next year. If there are no further questions, thank you guys so much for joining me on this call. Here's my contact info. So like I said, I like to consider myself pretty open. So hit me up via email or call me. I'm only a phone call away for any questions, or if you're interested in investing further, or you're an existing investor and you've got some questions on what we're doing, I'm only a phone call away. Last chance for any questions. All right, no more further questions. Thank you guys so much. I'm going to sign off and have a great day.